Yeah, thanks, Matt. As you said, Fed today, volatile events. I get questions a lot. How do you structure trade into a volatile event, right? And the answer is, well, I mean, listen, you can play the volatility. You can say, "Let I have no idea which way we're going to go, up, down, I don't know." Okay, um, but I know we're going to move a lot. And so, is there a way I can bet directly on the magnitude of the move, be it up or down, right? As opposed to having to guess direction. So this gets us into the world of volatility trading, and there's nothing better to introduce the topic than a long straddle because it is a pure bidirectional trade, right? So long straddle into an event. Now, there's two ways to teach this. The first way is the misleading way. It's to say, listen, this is the best thing ever. You win if the stock goes up or down. It's like, well, what's not to like? Sounds like you can't lose. Well, yeah, I didn't explain it right, right? Really, you should say you win if it goes up or down more than expected. Okay. So, what you need to do to analyze this and decide if you like the trade is figure out what's priced in, what's expected, how much movement are these options already baking into the cake. Then you can look at the stock market and you can say, well, I think it's going to move a lot more than that. You bozos, you're underpricing the straddle. I will buy it from you and make some money. Well, let's see what's being baked in here. We could use the S&P. The S&P is kind of expensive at $380. So buying calls and puts on that's going to be a little expensive. So what we're going to do is use a cheaper ETF, IWM, and buy a straddle on that. So the structure here is you buy an at-the-money call plus an at-the-money put. The call is bullish. That gives you unlimited upside if the stock goes up. The put is bearish. That gives you unlimited upside if the stock goes down. And so you're hoping that the stock goes up a bunch or down a bunch. So you make enough money on the winning leg to offset what you're losing on the other one, right? So what we're going to do here to make it a pure play on the Fed announcement today is we're going to use super short-term options. If I were to buy a 1 month straddle, you could. A lot of what you're paying for is not the expectation of today's Fed announcement. It's that plus 30 more days of movement in the market. So if you really want to isolate the bet and just say, I really just want to bank on if we move more than expected, like after the Fed announcement, the next day or two, then you got to use short-term options. So the time horizon here is we're going to use a 2-day option. It is Wednesday. Thursday would be day one. Friday would be day two. I guess technically it's 2.5 days. But options that expire on Friday. These are weeklies options. Little 2-day straddle here. So 2-day option at the money call, at the money put. Let's see what's baked in. We're at 179. 179 is the current price of the market. I want to buy a 179 call, and I want to buy a 179 put. Here's the 2-day options. They expire September 23rd. Here's the 179 strike, 50 delta. 50 delta. So this is a delta neutral trade. The call is going to completely offset the put, initially at least. And it's not terribly expensive. I'm buying the call for 290. Actually, that's the put. Buying the 179 put for 290. And then I'm going to control click and buy the 179 call. They're priced around the exact same price too, for another 290 or so. So about 576, 575. I like that number. 575 is my cost. What does that tell me? Well, if that is exactly at the money when I purchase it, the price of the straddle is the expected move. The reason why all the people that are buying and selling these calls and puts have collectively pushed the price to 575 for both of them is because that's how much movement they expect over the next 2.5 days. And so how do I know that? Well, when you go to analyze and you analyze this trade, the break-even points are the expectation, okay? If the market moves as much as expected, you should break even. If the market moves exactly what's priced in, you shouldn't make money. Where you make money on this sucker is if it moves more or less than expected. Well, less you would lose, but more than expected. So I'm going to add me another price slice here. And I'm going to click here, set slices to break even at expiration. So those are the break evens: 184.70, 173.25. And I can put that on the chart. Let me clear my other gunk here. Let's clear that. Clean chart, go to the risk graph, slices to chart. Boom. That right there is the range that's being priced in over the next 2.5 days. What do you think about that? 5.75, $5.75, up or down? Well, IWM has an ATR of $4. So it's pricing in basically 1.5 ATRs over 2.5 days. If you think that's too little, then you'd want to buy this straddle. Okay. And by the way, I'm talking about this at expiration. If it hits these today, you're going to make some money. So basically, the way this works is there's a distinct correlation, a relationship between time and expected movement. The break evens get wider as time passes because you're suffering more time decay. I need enough movement to offset the 2 days of time decay I'm going to suffer. Remember, these are at the money options. They're not in the money. The entire $5.75 that you're paying is extrinsic value. That's gone in 2 days. You're going to suffer $575 of loss in time decay in 2 days. How are you going to make money? You need to make more than $575, or let me say it another way. You need to accumulate more than $575 of intrinsic value to offset the $575 you're losing in extrinsic value. But for that to happen, one of these two options needs to go $5.75 in the money. Either the calls needs to go $5.75 in the money, or the put needs to go $5.75 in the money. That's at expiration. Now you may say, Tyler, I'm no dummy. I'm not going to hold this till Friday, end of day. I'm going to get out on Thursday. Well, fine. Then you analyze this based on where the break evens are in 1 day instead of 2. And essentially, what would I do? I would take the date here and I would advance it 1 day. Okay. In fact, I'd probably do 2 days. I think this is essentially what it is, like beginning of Friday. At any rate, these red dots, red bars here, that reflects your break even. So a day from now, market's got to be below 177 or above 181, right? 2 days from now, presumably like Friday morning, we got to be 174, 184. And then if you hold it to expiration, end of day Friday, you got to be 173, 185. Okay, so the point is you got to move more each day to offset the time decay. What you don't want to happen is for the market to take a nap and be like, Fed schmed, we don't care. We're going to end with a doji today. It's like, hey, buddy, you got to move like $5.75 up or down. Snappy, snappy, like get a move on. Time decay is eating my lunch here. So you need it to move. If it doesn't move, or quite frankly, it's not just you need it to move. You need it to move in one direction and not come back. Like scram, get out of here. Up, down, I don't care. Do not come back to 179. What will be frustrating is if the market goes up big, maybe today after the Fed meeting, and you don't take profits on your straddle, and then tomorrow it goes down big, right? And down big, and then on Friday it comes back up. You know, on Friday you're riding this into expiration, and we're still settled around 179. Now that would be frustrating because you got volatility, but it wasn't in one direction or the other. It was just choppy chop. Okay. So those are the characteristics of the straddle. If I was managing this, I would not risk the entire 575. I think that if the market snoozes and doesn't move over the next day, day and a half, I'd be getting out of this thing at probably $100, $150, $200 loss. See you later. If it moves, you've got a decision to make. Okay. If the market's ripping and you're getting into profitable territory, this straddle, this bi-directional trade becomes a directional trade. The market goes up, you want it to keep going. Okay. And so treat it like a bull trade. If it keeps going up, let it ride. Market starts to reverse and come back down, maybe breaks intraday support or breaks a prior day's low, skedaddle. You don't want it to come back to 179. Same thing applies on the downside. If we crash after the Fed announcement and you're starting to make money on the straddle, great. Don't let it come back. If you get a big down day and then the market starts to have a big reversal back towards 179, get out. So it starts bidirectional. It becomes bullish if we go up. It becomes bearish if we go down. You should manage it as such. And you should probably have somewhat of a tight leash, given that you only have 2 days. Okay. Now, I don't really have a strong opinion on this trade. Final point. I don't have a strong opinion on the trade. What I hope that you've learned through this exercise is understanding how the market prices in a certain amount of movement, how you can build the trade and analyze what's baked in, and see if you have an opinion. You know, if you have an opinion, play. If you don't have an opinion, don't play. If you don't feel like this is an easy play, don't do it. Okay. One thing I think is a key takeaway for me is the market's pricing in a decent amount of movement over the next 2 days. That makes it hard for me to buy this straddle, right? Because I feel like this range is pretty big for 2 days of movement. And yeah, we could definitely move that much, but I don't really have a strong opinion. So for me, this isn't a trade I would do.